Averaging down is a trading strategy employed by investors. It involves purchasing additional shares of an asset after its price has decreased. The primary goal is to reduce the average cost per share of the investment. This strategy is based on the expectation of a future price recovery or rebound. Investors believe the asset's price will eventually increase, leading to profits. Averaging down can be risky if the asset's price continues to decline significantly. An investor initially purchases 100 shares of XYZ stock at $50 per share. This initial investment amounts to a total of $5,000. Subsequently, the stock price declines to $40 per share. The investor then decides to purchase an additional 100 shares at the reduced price. This second purchase requires an additional investment of $4,000. The investor now holds 200 shares of XYZ stock acquired at different price points. The average purchase price is calculated after multiple stock acquisitions at different prices. First, calculate the total cost of each purchase by multiplying the number of shares by the price per share. Then, sum the total costs of all purchases to find the overall investment. Finally, divide the total investment by the total number of shares purchased to determine the average price per share. Averaging down involves purchasing more of an asset after its price has decreased. This strategy lowers the average purchase price of the asset. For example, if the original break-even point was $50, averaging down might reduce the break-even point to $45. The perceived advantage is needing a smaller price increase to recover the investment. Risk of ruin, ROE, represents the probability of a trader losing all of their trading capital. It is a critical concept in risk management for traders and investors. ROE quantifies the likelihood of complete financial loss in trading activities. Certain trading strategies can significantly elevate the risk of ruin. Averaging down without careful management increases the ROE substantially. Therefore, proper risk management is essential to mitigate the risk of ruin. The risk of ruin, ROE, quantifies the probability of depleting one's trading capital. The formula for estimating ROE is ROE equals 1 edge divided by 1 plus edge, capital divided by risk per trade. Edge represents the trader's expected advantage in the market. Capital refers to the total trading capital available. Risk per trade indicates the amount of capital risked on each individual trade. A trader begins with a starting capital of $10,000. The trader decides to invest in ABC stock. ABC stock is currently priced at $50 per share. The trader purchases 200 shares of ABC stock. This purchase utilizes the trader's entire capital of $10,000. 200 shares, x $50 share. The trader is now fully invested in ABC stock with no remaining capital. A decrease in stock price impacts the overall value of an investment position. If the stock price drops to $40 per share, the total position value is affected. In this scenario, the position is now worth $8,000. This valuation reflects a loss compared to the initial investment. The loss is quantified as 20% of the original investment amount. Therefore, a stock price decrease directly translates to a reduction in investment value and a percentage loss. A trader employs an averaging down strategy by purchasing additional shares after the price declines. In this scenario, the trader buys 200 more shares at $40 each, totaling an $8,000 investment. However, the trader only possesses $2,000 in available cash. To complete the purchase, the trader leverages margin, which is borrowing funds from their brokerage. Margin allows investors to increase their purchasing power by using borrowed capital. This strategy amplifies both potential gains and potential losses due to the increased leverage. The trader's current holdings include 400 shares of a specific asset. The average purchase price for these shares is $45 per share. The trader has an outstanding margin debt of $6,000. This debt represents funds borrowed to finance the share purchases. A stock price drop to $30 results in a position value of $12,000. Subtracting the $6,000 margin debt leaves a net equity of $6,000. The net equity of $6,000 represents the investor's remaining capital in the position. This outcome reflects a 40% loss from the initial capital investment. If the stock price drops to $20, the investment's value decreases to $8,000. A margin debt of $6,000 is associated with the investment. The net equity is calculated by subtracting the margin debt from the investment's value. The resulting net equity is $2,000, $8,000, $6,000. This represents an 80% loss on the initial investment. A margin call indicates a high probability of forced position liquidation. Liquidation occurs when an investor's account falls below the required margin. This forces the sale of assets to cover losses. Forced liquidation can result in significant capital depletion for the trader. In severe cases, it can potentially wipe out most of the trader's invested capital. Margin calls are a critical risk factor in leveraged trading. Averaging down carries the risk of capital exhaustion. Capital exhaustion occurs when a trader depletes their funds. This can happen before the asset price recovers to a profitable level. Insufficient funds prevent further averaging down or riding out the price decline. Averaging down involves purchasing more of an asset as its price declines. This strategy can inadvertently increase concentration risk. Concentration risk arises when a disproportionate amount of capital is allocated to a single investment. Averaging down amplifies this risk by tying up more capital in a potentially underperforming asset. This can lead to significant losses if the asset's price continues to fall. Attempting to catch a falling knife refers to buying an asset as its price rapidly declines. A significant risk exists that the asset's price may never recover. This can lead to a permanent loss of invested capital. Companies facing bankruptcy, such as Enron, exemplify this danger. Even established firms, like Lehman Brothers, can experience irreversible declines, making catching them perilous. Capital invested in underperforming trades incurs an opportunity cost. This cost arises from the inability to allocate those funds to more promising investments. Losing trades effectively lock up capital. This prevents its deployment in ventures with potential for profit. Therefore, opportunity cost represents the foregone gains from alternative investments. Averaging down is a strategy where investors purchase more of an asset as its price declines. The intention is to lower the average purchase price of the asset. However, this strategy is often influenced by emotional factors like hope rather than rational analysis. This emotional decision-making can lead to poor investment choices. Relying on hope instead of sound financial principles increases investment risk. Position sizing is a risk management technique used in trading. It determines the appropriate amount of capital to allocate to a single trade. A common rule is to risk only 1 to 2% of total capital per trade. This limits potential losses from any single adverse price movement. Adhering to this rule helps preserve trading capital over time. The portfolio limit rule restricts the amount of capital allocated to a single investment. This rule typically sets a maximum percentage, such as 5 to 10% of the total portfolio value. The limit applies to any single position, including stocks, bonds, or other assets. Adhering to this rule prevents overexposure to any one particular asset. By diversifying, the portfolio reduces risk associated with the performance of a single investment. When averaging down, maintain purchase sizes smaller than the initial position. Smaller purchase sizes help to minimize the impact of subsequent price drops. This strategy reduces the overall risk associated with averaging down. It allows for more controlled adjustments to the position as the price fluctuates. Therefore, Smaller purchases offer a more conservative approach to averaging down. Averaging down involves purchasing more of an asset after its price has decreased. This strategy aims to lower the average purchase price of the investment. However, averaging down should only be considered if the initial investment thesis is still valid. The fundamental reasons for the initial investment should not have deteriorated. If the original reasons for investing are no longer present, averaging down may increase losses. Therefore, reassess the investment's prospects before deciding to average down. Averaging down is a strategy to reduce the average purchase price of an asset. This involves buying more of the asset after its price has declined. Consider averaging down only at significant support levels. Support levels are price points where the price has historically rebounded. Predetermine exit points in case the price continues to fall below the support level. This helps to manage risk and limit potential losses. Pyramiding up involves incrementally increasing an investment in a winning position. An initial position is established as the foundation of the strategy. Subsequent additions are made only when the price moves favorably. Each additional investment should be smaller than the previous one. This scaling approach aims to maximize profits while managing risk. Markets can remain irrational for extended periods, defying logical analysis. Persistence in an irrational market can lead to financial ruin, regardless of investment strategies. Averaging down investments will not prevent bankruptcy if the underlying company fails. Strict risk management is essential to protect capital against unpredictable market behavior.